Okay, so our next session is a little bit more focused on regulation. We have the team from Arendt Regulatory and Consulting here. So we have Naveen El-Sharif and Pierre Schmidt, who are, come on the stage. You are very welcome. You're going to talk to us about, I don't know, red tape, green ambitions, the usual challenges that we have in terms of regulation and market evolutions. So I leave the stage to the two of you. Nevin is a sustainable finance manager and ESG advisor, or yeah, okay, welcome, thank you.
Hello everyone, thank you for your attendance today. Okay, so it's this one? Okay. So we're very happy to be here with you today, together with my colleague Pierre, to present to you some insights about the changes that have happened in the sustainable finance area, mainly in the regulatory area in Europe, but also in other jurisdictions, and the impact of that on investors, on the market, on fund managers. But before we start, I just want to again reintroduce myself. Sorry, not very... Okay, so my name is Naveen. I'm a manager at the ESG and Sustainable Finance team at Arendt Regulatory and Consulting. Me and Pierre were working in that team for, I think, a couple of years now, and we've been assisting a lot of asset managers, mainly fund managers, but also corporates in their SFDR, CSRD, ESG compliance journey. And with that introduction, I will just give you an overview about the structure of our presentation today, and I would leave the floor to my colleague Pierre. So the first part of the presentation today is we're talking about the main ESG-related frameworks, regulatory frameworks in Europe that have shaped or have paved the road for other regulations outside Europe. What happened in these regulations in the past few years, in the past few quarters, all the changes, all the evolutions. And after that, we will try to get a snippet of what's happening in the local markets, with the local rules, with the regulators, with the investors in different jurisdictions. And now with this brief introduction, I leave the floor to Pierre. Thank you.
Does this work? Does it work like, yes, it works like this. Okay, perfect. So, first off, let's start with a quick introduction. Why do we care about sustainable finance? Why does it matter? So if you look at the graph, you will see that over the last 60 years, there has been slow development, but it's really in the last decade that we have a strong increase in ESG regulatory developments across the world, highlighting really the importance of ESG and the matter that we need to focus more on it. More importantly, you will see that there's actually one specific area where we have seen a lot of developments, notably Europe. In Europe, we have established, or the Sustainable Finance Action Plan was established, where the aim was to reorient capital flows towards sustainable investments, integrate sustainability risks into mainstream risk assessment, and finally to foster transparency and long-termism. You will see here that on a European scale, there have been a lot of regulations and initiatives been established to help focus this plan. However, today we will focus mainly on the taxonomy and the Sustainable Finance Disclosure Regulation, or SFDR for short.
Thank you, Pierre. So now zooming in a bit into the main frameworks, as we said, SFDR to start with. So as Pierre mentioned, SFDR, or the Sustainable Finance Disclosure Regulation, or the Disclosures Regulation, is not new. It has been there since 2019, with an effective date since March 2021. And the idea about the SFDR, maybe we can think about it on two levels. The level 1 SFDR of 2021 was a very, let's say, relatively high-level disclosure regulation, where it requires market participants, financial market participants, and financial advisors to be transparent on the level of sustainability or the level of sustainability commitments that they make at product level, at fund level. And with that, the regulation introduced broad categories, the famous Article 6, Article 8, and Article 9 funds products or funds types, with the 6 being the least ambitious, just integrating sustainability risks, and the 9 being the most green, with only making sustainable investments under specific criteria. So this was the broad idea. The disclosures varied from being required at entity level, at financial market participant level, with respect to whether they consider sustainability risks, they integrate sustainability risks into their internal processes, or they even consider some principal adverse impacts on the environment and the society. But also the regulation or the level 1 introduced high-level disclosure requirements at product level, meaning fund level, at website, pre-contractual disclosures, and periodic reporting. Now with the level 1 done in 2021, it was amended further in 2023, let's say in the 1st of January 2023, where we received, or the Commission issued the delegated regulation. This delegated regulation expanded the scope of disclosures. So instead of having high-level disclosures, now we have predefined pre-contractual and periodic templates at product level for Article 8 and 9, the famous yellow templates with the yellow opening boxes that you see on the top right. But you also have more detailed requirements to submit at website level for each Article 8 and 9 products. And then you also have a more detailed expectations or requirements if the entity decides to consider principal adverse impacts. Now, it did not stop there. Again, in the same year, February 2023, the delegated regulation was further amended by amending the pre-contractual and periodic templates and adding a section on taxonomy-aligned fossil gas and nuclear investments. Why am I saying this? It's because since day one, it has been evolving, and there was a lot of changes along the timeline. Now, how did this so far? As we know, this is the last thing that we know that's applicable as of this date, the second amended delegated regulation. How did this impact the market? So looking at this Morningstar data, so this is an extract from Morningstar data, it shows you how the market is split between the different types of SFDR products that the SFDR entitles. We have mainly half of the market split. The market is split between Article 6 and Article 8 products, with a very minor portion relating to Article 9, which means, or which implies actually and proves the fact that Article 9 being very ambitious, they attract more scrutiny from the investors, from the stakeholders, from media, and even from the regulators, because the expectations for those Article 9 super green products are higher, while Article 6 and 8 are easier to digest because the requirements there is less ambitious, let's say. So beyond this, what happens, here we're looking at the, let's say, the fund manager perspective. What about the investor's perspective? So again, based on Morningstar data, you see here the data from the last 4 quarters. And here we talk about the net flows of the funds. So meaning how interested the investors are in a fund and how not interested they are. So positive means net inflow, which means a lot of investors are putting their money into those types of funds. And of course, beyond negative, it's outflow. There you can see that mainly investors are interested in Article 6 and 8 products. The flow of money into those kind of funds is higher. And then you see Article 9 having limited inflows, but at the same time, they have sometimes higher outflows or more probability to have outflows than the counterparts Article 6 and 8. So again, because of scrutiny for Article 9, because of unclarities, because of higher expectations, it's not very stable for Article 9s. It's not very famous as the Article 6 and 8s. Now, we saw what happens until now. What will happen next? The regulation did not stop evolving. So as recent as, not very recent now, it's been some time, April 2023, there was publication by the ESA, the joint consultation paper, to review the level 2 delegated regulations, which means to amend the regulation that has the latest pre-contractual and periodic templates, the orange boxes, they completely propose to revamp these templates, to change many aspects, to add a lot of sections or different sections on greenhouse gas emissions, to enhance principal adverse impact reporting, clarify some expectations on the regulation. The final report included all of these proposed changes that was issued in December 2023. And this was never endorsed and never saw the light. Why? Because in parallel, the SFDR, there were discussions at European Commission level to revamp the SFDR level 1. The SFDR level 1, as we mentioned, is the core of the regulation. It's actually the structure, it's the base of the regulation. They wanted to amend it. They were looking into the usability, if it's good, if something needs to be enhanced. And based on the feedback of the consultation papers and the public consultation and the call for evidence, they came up with the idea that there's probably going to be a lot of changes to the base, and hence why the SFDR level 2 amendments will be put off the table as for now. The SFDR level 1 amendments are mainly to change the SFDR from being a transparency regime to being a labeling exercise. So you have 3 main or broad product labels: sustainable, transition, and other ESG, where each product can fall under it with a very strict specific criteria. So the idea here at the end is just to show you that the regulation is still evolving, even though it has been there since 2019, and we don't know yet what will happen. But what we know for sure, or based on the European Commission clarifications, is that we're expecting the first legislative proposal for the SFDR revamp by the end of this year. And after that, we will see if they will have to change the level 2 templates or not. Now, I leave the floor to Pierre for taxonomy.
So, let's talk about evolving regulations, specifically. The EU taxonomy, as you can see, it has changed a lot. Maybe as a quick introduction, the EU taxonomy is a classification system that allows to classify economic activities as sustainable as long as they contribute to an environmental objectives, do no significant harm to environmental objectives, and adhere to the minimum criteria. Now, this is a very brief and simplified overview. There's a lot of technicalities behind this. When looking at the development of this regulation, you will see that the first one was introduced in June 2020 and has since then seen a lot of delegated regulation to it. This is in one part because, as already said, it's a very technical and complicated regulation that requires further information, but also because this is a regulation that is continuously evolving and trying to adapt to the current market developments and geopolitical trends. The most important point to note now is that we've reached the point where all 6 environmental objectives have been or have received necessary criteria, already covering a large part of economic activities that can now be categorized as sustainable. Even here, you will see, if you look all the way to the right of the slide, that we're also expecting further developments, which in this case are expected to be simplifications to the reporting requirements under the EU taxonomy. Now, when looking at the fund market, you will actually see that there is very little ambition when it comes to taxonomy alignment, almost none if you actually look at the 0% minimum commitment, which is not because people are not, or because funds are not interested, but rather because the requirements that come with being taxonomy aligned are very complicated and can limit the investment options significantly. However, irrespective of the minimum commitments made by funds, they still need to report on taxonomy alignment under the SFDR, which explains why, when you look at the right side of the graph, why we see higher reported taxonomy alignments than what is actually committed. This also provides a bit more of a positive outview in the future because we see there is taxonomy alignment and potentially in the future we will then also see higher commitments.
So now we saw the evolution of SFDR and EU taxonomy until today. We want to see what happened in local markets and what were the reactions. So they have evolved a lot, and the goal at the end, and we all agree that it's to enhance transparency and to curb greenwashing. But how did that impact the presentation of the fund to investors, marketing-wise, and how do fund managers present these funds marketing-wise? How do they say, this fund is sustainable or not? One direct outcome of this is actually our famous ESMA guidelines on fund names. So these are EU rules that were published by the ESMA, and they are applicable as of May 2025 for existing funds and October 2024 for new funds. And the idea about these rules is, again, it's just emerging from the SFDR. These rules will not be there if SFDR did not exist. So again, it's evolving. It's like a lot of parts of local rules that emerge from this aspect. So the idea here is that if a fund uses a certain ESG-related term in its name, it has to comply with specific requirements. So the ESMA guidelines divided the type of terms in the names into these categories. You have sustainable, environmental, impact, social, governance, and transition. Under each category, you have specific requirements that has to be taken into account for each fund if they decide to use the name or the term that they fall under. If they use two terms at the same time in the name, for example, I call my fund Environmental Sustainable Fund, then I will have to apply both criteria with the more stringent criteria applying on top of the other. Again, we don't need to go in details, but the idea is that there are specific minimum requirements. At least 80% of the fund's investments using ESG-related terms have to comply or to relate to the theme of the topic in the investment strategy and in the binding elements. But on top of that, there is also certain exclusions that apply based on the different types of terms, and these are defined by the Paris-aligned benchmark exclusions list and the climate transition benchmark exclusions list in the benchmark regulation. And some specific terms like sustainable, impact, and transition, they have additional requirements that they have to apply if the fund manager decides to use this kind of term. Now, how did that impact the market, or at least on the fund manager side? Based on the data you see here, this is mainly the activity of renaming that happened in the past quarters. And you can see here that it has been a bit dormant in the last quarters until Q4 2025, where it spiked a bit. And this is at least for the Article 8. And this is because of the first application date of the ESMA guidelines on fund names, where Article 8 fund managers decided mainly to drop ESG terms because their funds do not comply with these minimum requirements. But then some of them started to change the ESG terms, shifting between sustainable to have environmental to have a lower requirement. And then others also added some ESG terms. They were more ambitious. On the Article 9 side, on the other side, you see that the activity is a bit different, with mainly fund managers changing ESG term and adding ESG terms than dropping, because Article 9 by nature are more ambitious, so there's a higher probability that they already comply with the requirements of the term even before the application of the guidelines.
So further outcomes of the SFDR is also a lot of clarifications and guidances. If you can see, there's in the past month, there have still been 4 different clarifications and guidances published, notably the final CSA report, the ESMA thematic notes, there have been updates to the Q&A, and finally the PIE report. The details, I will not bore you with it. The most important part to note here is that all of these documents provide clarification either on what is good practice and what should be further improved, or on what is considered bad practice and market players should still work on to improve on. Again, showing that despite the regulation being now a bit older, there's still a lot of room for clarification and need for guidance on fund managers on how they propose their information.
And then zooming in a bit to Luxembourg at local level, so shifting from Europe to Luxembourg, we also have the CSSF being very active in providing or maybe imposing additional rules, but also in providing clarifications. One example of the rules that they have provided is the data collection exercise. Again, it's not a new rule, but it emerges from the SFDR regulation in general. So the idea here is that CSSF requires market participants to submit the pre-contractual and periodic information of their products into the CSSF database for the CSSF to collect the data about Article 6, 8, and 9 funds. So it has a repository of the data of all the sustainable related commitments, but also to use this data to compare against periodic reports and pre-contractual commitments. For example, if you're in Article 8 and in the pre-contractual commitment you submit to the CSSF saying, I have 80% alignment with the characteristics, but I report in the next year 70% alignment, the CSSF will flag this on the system, and they will probably investigate further why is this discrepancy. So this is one example of the additional disclosure requirements imposed at local rules in Luxembourg. But also CSSF has been very generous with providing a lot of clarifications in the recent years. This is a list of some of the some of them, but not all of them. The famous thematic review in 2023, where CSSF provided additional clarifications on the expectations of how the disclosures should be provided based on survey and based on inspections in market participants in Luxembourg. We had the famous SFDR frequently asked question. So list of questions that the CSSF has answered. You also had the CSSF annual report providing a snapshot of the year, but on top of that you have more clarifications and so on. And on an ongoing basis we have the CSSF mock inspections, and this is an exercise that the CSSF has rolled out, randomly checking different asset market players and assessing their disclosures and if they comply with the expectations set by the regulator or not.
So now moving to one of our neighboring countries. As a first question, does sustainability and defense go together? I will not take any answers because this will probably raise very complicated discussions. However, Germany has changed their approach to this. With the recent changes in the geopolitical development, notably specifically the war in the Ukraine, they have become more lenient on this approach and have changed their revised the ESG market concept by removing the exclusion requirement for companies that make more than 10% of their revenue from military hardware. While they have kept the banned weapons, they have significantly reduced the requirements when it comes to defense investments, showing again a change related to SFDR that is also dependent on the geopolitical development.
And now leaving the continent and going to the US. Again, it was not easy, but I'm not gonna give you a lot of details on that because there's a lot to discuss on the US side. But the idea here is just to let you know that given the recent ESG backlash of the administration currently, there has been a lot of backing off from a lot of, let's say, US-based or US applicable regulations. For example, we have the names rules. So the SEC, at some point in 2021, they proposed amendments to the names rules. It's very similar, or not very similar, but it's the same idea of the ESMA guidelines on fund names, where if you use a certain term in the name of the fund, you have to apply specific criteria. The proposal of this or these amendments were adopted in September 2023 with the initial effective date in December 2025 this year. But recently, with the ESG backlash happening and all the decisions to sign off from the Paris Agreement and all of this backing off, the naming rule has been postponed further, pushed down the timeline to June and December 2026. So again, this is one example of the state in the US. They have some things in hand, some proposals, some regulations, but they did not go further because of all the backlash and all the geopolitical changes around happening in the US and in the world. So how did this impact investors? Looking at our famous Morningstar data. So you see here that we have, on US level, you have more of an outflow trend, which means that investors are pulling out their money from, let's say, sustainable funds. And it has been a bit consistent throughout the past quarters, of course, with the big dip in 2024 with the high interest rates. But again, you see that on the US level, even market demand is not very keen to invest in sustainable funds. And again, this reflects the uncertainty happening in the US for the ESG funds market, the ESG regulations, and so on. So yeah, I mean, this is just on the US side, there's a lot of other things that's happening in terms of ESG. We have a lot of other corporate-related sustainability disclosures. Again, they were put on the table and then taken off because of all what's happening. But then on that note, I leave the floor to Pierre for going further.
Yes, moving to yet another continent. When looking at Asia as a whole, we see actually positive development. We see that there's more and more countries that are developing taxonomies in their country. And we even see some countries, notably China and Japan, who are starting to develop mandatory disclosure requirements. So while this is a positive trend, there's also certain limitations that come with it. Because all the countries are developing, or most of them are developing taxonomies on a national level. There's a fragmentation across the countries, making it more difficult to have a unified sustainable investment approach and limiting a bit the investment option. However, we will also look at one country as an example. So, for example, Singapore or the Monetary Authority of Singapore closed its consultation on the taxonomy in July 2023, and then already in December 2023, the voluntary taxonomy was officially launched. Important to note in this case, voluntary, because then there's still a lot of flexibility for funds to adhere to it or not. In this case, the taxonomy is approached by a traffic light system where you first have the green category, which consists of environmentally sustainable. You have the amber category, which stands for transitions. And finally, you have red, which are ineligible activities. While I was mentioning earlier that there's a lot of fragmentation happening in Asia when it comes to taxonomies, we still see already the right trends in the right direction. Because in November 2024, the Singapore, in collaboration with the People's Bank of China and the Europe, has actually started to work on a document to work on the interoperability between the different taxonomies, showing already the ambition for a more global approach, but we have yet to see how this will be implemented in the long term. Now coming to some developments on the continent. In terms of fund flows, we actually have a bit of a more positive outlook than in comparison to the US. Maybe just to warn you, the one strong dip in Q20 2024 seems to be related to a lot of changes, or seems to be related to a lack of trust in the energy sector, as well as stronger requirements in China, making some investors a little less confident. However, we overall see an increase in the last couple of years, notably around 1.7 billion increase in the second quarter of 2025. Here, just as a small disclaimer, this is to represent Asia, but the inflows are more focused on certain countries such as Hong Kong, Taiwan, and Japan. Taiwan.
Okay, so I think we're done, but we need to take away something from this presentation. And the takeaway actually is that we don't know what will happen next. You see a lot of evolutions. It initially started at EU level with SFDR. Other jurisdictions, whether in the EU or externally in the US, in Asia, they started to replicate and try to work on a more harmonized framework. But again, with all the changes at EU level, with all the geopolitical tensions and changes globally, it's very hard to tell what will happen next. We thought by that time, after 4 years of the SFDR, that everything will be stabilized. But again, it seems to be not the case until now, because there's a lot of discussions of coming changes, coming interpretations, and a lot of things that will probably change. And even though we're happy to keep the business, we're still not happy that investors are facing a bit of uncertainties. So with this, I think we can conclude.
Thank you very much. So there's time for one or two questions. Does anybody have a question? You have like the hottest regulatory team on stage, huh? So if you've got a question, now's the time on the regulations. No? Yeah, we have one question. Excellent. Who's coming with the mic? Huh? Rebecca, thank you.
Thank you. Thank you very much for the presentation. It's not exactly a question, more a compliment, but I think it might interest everyone. You mentioned a lot all the uncertainties around SFDR, level 1, level 2. So the good news is, at least at the level of the level 2, that uncertainty is gone. So last week, the European Commission published a report where they officially decided to deprioritize 115 level 2 acts, and RTS for SFDR are part of them. So at least we know that before 2027, there will be nothing moving at that level. But of course, everybody's looking at what is happening at the level 1 that should be published next month.
Exactly. So thank you for this. Indeed, the European Commission published a week ago, I think. It was a deprioritization list of all the level 2 acts that are currently being looked at. And one of those was the SFDR or RTS. So they deprioritized the level 2 amendments, which is the new templates we talk about, until the level 1 is stabilized, because it doesn't make sense to amend the level 2 while the level 1 structurally is being revamped. So thank you very much.
Okay, brilliant. Thank you both very much. And thank you again. And thank you.
Thank you.